Okay, let's dive right into this explainer and explore the genuinely fascinating world of IAS 8. Because today, we're figuring out how and exactly when accountants are actually allowed to rewrite history. We're going to completely unpack the rules that dictate how a company presents its financial reality. And honestly, it's a lot more dramatic than you might think.
I mean, think about it. Once the year is closed, the books are shut for good, right? Well, that brings us to a rather massive question. Can a business legally go back and just change the numbers it already reported to the world?
You might be surprised to hear that not only is it totally legal to change the past, but under specific circumstances laid out by IFRS, it's an absolute requirement. It all boils down to ensuring transparency. Anyone looking at the numbers needs to be able to make a fair, apples-to-apples comparison over time.
So we have a lot of ground to cover. Here is our roadmap for this explainer. First, the Accounting Policy Rulebook. Second, changing policies retrospectively. Third, changing estimates moving forward. Fourth, fixing past errors. And finally, redefining what is material.
All right, let's start by setting our baseline with Section 1, the Accounting Policy Rulebook.
The absolutely crucial point to understand here is that accounting policies aren't just some vague ideas or loose guidelines. They are the hard and fast rules. We're talking about the specific principles, bases, conventions, and practices a company adopts to prepare its statements, whether that's choosing a cost model over a revaluation model or deciding exactly how to recognize revenue. These policies literally shape the entire financial narrative of an organization.
Now, management can't just cherry-pick whatever policy makes their bottom line look the best. There's a strict hierarchy they have to follow. Step 1, check if there's a specific IFRS standard available. If there isn't, they move to Step 2, where management uses their judgment to develop a policy based on the conceptual framework to make sure the info is actually reliable. And if all else fails, Step 3 allows them to look at pronouncements from other standard setters, like US GAAP or established industry practices, just as long as it doesn't conflict with IFRS.
But what happens if a company needs to alter those rules? That brings us to Section 2, changing policies and retrospective application.
This right here is our financial time travel. If you change an accounting policy, maybe a new mandatory IFRS standard came out, or maybe you voluntarily switched because a new method gives better information, you have to use retrospective application. That means firing up the time machine, going back and rewriting your comparative historical data as if the new rule had always existed.
Let's look at a quick mini case study from our source material to see this in practice. Imagine a carpet retailer. Previously, they sold carpets, fitted them themselves, and recognized the revenue when the fitting was completely done, which usually took about 6 weeks. But now, they've decided to subcontract the fitting to self-employed workers. Because of that shift, they now recognize the revenue right at the point of sale. So ask yourself, based on what we just covered, does this retailer need to use retrospective application and restate all their past revenues?
The answer is no. And this perfectly illustrates a vital distinction. This is absolutely not a change in accounting policy. The retailer simply changed a real-world business process, literally just how the carpets get fitted. They didn't change the underlying accounting principle of how revenue is recognized based on the delivery of a service. So the past stays the past. No restatements required.
On the flip side, what happens when a company changes its actual accounting method? Let's say they move from a first-in, first-out, or FIFO inventory valuation over to a weighted average method because it gives users much more reliable information. Now, that is a legit policy change. In this scenario, they absolutely must go back and recalculate their inventory for all those prior years, completely replacing the old FIFO numbers with the new weighted average numbers for their comparative statements.
Let's move on and see how estimates differ from those strict policies in Section 3, changing estimates, moving forward.
If you take away just one thing from this explainer, make it this distinction. Policies force you to look backward and use retrospective application. You rewrite the past, but accounting estimates, they use prospective application. They strictly affect the current period and the future. No time travel required whatsoever.
And that makes sense, right? Because estimates are exactly that, just estimates. They are management's best educated guesses based on new information or accumulated experience. Think about recalculating warranty obligations, or reassessing a provision for doubtful debts. Or maybe realizing that a building you originally thought would last 50 years actually only has 32 years of useful life left. When new facts come to light, you just adjust your math for today and for tomorrow.
I absolutely love this practical little built-in safety valve from IAS 8. When it is incredibly difficult to distinguish whether an update is a change in an accounting policy or just a change in accounting estimate, the standard rule of thumb is to treat it as a change in estimate. When you're in doubt between time traveling or moving forward, just move forward. Treat it prospectively.
Of course, companies aren't perfect, which brings us to the slightly more scandalous side of accounting in Section 4, Fixing Past Financial Errors.
Prior period errors happen when reliable information was totally available, but it was either missed, ignored, or intentionally misused. When material errors pop up, whether it's an innocent omission by a tired accountant or a deliberate, calculated fraud, IAS 8 pulls zero punches. It demands a retrospective restatement. You have to go back and correct those comparative amounts as if the error never, ever happened.
Let's look at how a massive mess actually gets cleaned up. Imagine a company discovers a $12 million fraud in 2020 that spanned 4 whole years. It's fascinating how surgically this gets dismantled. The $2 million from the current year, 2020, simply hits that year's profit or loss. The $3 million from 2019 gets corrected by restating the 2019 comparative profit. But what about 2017 and 2018? Because those years are before the earliest comparative period shown, that combined $7 million is pushed straight into adjusting the opening retained earnings for January 1st, 2019. It transparently flushes the historical damage right out of the system.
Finally, we really can't talk about transparency without addressing Section 5, redefining what is material.
The ISAB recognized that companies were really struggling with the old definition of materiality, so they went ahead and updated it. And the most critical addition is one very specific, very powerful word: obscuring. This represents a massive shift in how companies are expected to report their financial data.
Grant Thornton had some fantastic insights on this amendment. Adding the concept of obscuring essentially means you can't just hide bad news by burying it in a 500-page document packed full of useless, immaterial fluff anymore. Obscuring the truth is now treated just as severely as leaving it out entirely. Also, the phrase reasonably be expected to fixes the old threshold, which a lot of people felt was way too low. And it makes it crystal clear that the primary users we are fiercely protecting here are the investors, lenders, and creditors who absolutely rely on these statements to make massive economic decisions. The data has to be clear, concise, and direct.
As we wrap up this explainer on IAS 8, I want to leave you with a provocative thought. Mastering retrospective policies, prospective estimates, and correcting past errors isn't just some dry exercise in technical compliance. It's about honoring the true spirit of financial transparency. Are your numbers telling the real, unfiltered story of the business, or is the truth getting completely lost in the noise? Thank you so much for joining me to unpack these critical standards. Keep digging into the data, and I will see you in the next explainer.